Howdy everybody, in today's stock analysis video we are going to be analyzing Electronic Arts, otherwise known as EA, and with me today I actually have a very special guest which she has been on this channel before. Introduce yourself.
Hi, everybody.
And who are you?
Angel's girlfriend.
She is my girlfriend and she actually wanted to do EA because, well, one of her most favorite games is on here. What is it, sweetheart?
Sims.
You like Sims?
Yeah.
Well, you like Sims, and one of my favorite games, pretty much of all time. I've only ever played like Battlefield Bad Company 2, but Battlefield. I love Battlefield. It's awesome. It's so sick. Like, you have no idea how much I love this game. But in addition to Battlefield and Sims, they also have FIFA, Madden, F1, and Apex Legends. So with that said, let's get started with this analysis. Currently, EA is actually trading at $125.64 with a 52-week high of $150.30. As you can see here by this graph, this actually has gone down a significant amount by around $25. Now, does this actually mean that this is buy? Well, we're going to find out based on this company's fundamentals. Starting off, we got the dividend summary, and sweetheart, look, they actually do pay a dividend.
Wow.
Look at that. So they have a dividend yield of around 0.54%. And this doesn't really mean much because this changes based on the ticker price. When the ticker price goes down, this yield goes up, but when the ticker price goes up, this yield goes down. Make sense?
Yeah.
So what you really want to look at is the amounts per share, which in this case is
17 cents.
so they pay 17 cents a share for an annual payout of 68 cents. Payout ratio in regards to the net income is 9.7%, which is actually really good. Like that kind of payout ratio tells me that like it's really good. However, what's wrong with this is that this is in regards to the net income. Companies do not use their net income to pay dividends. They use their free cash flow. So we're going to calculate the free cash flow and then take a look at the payout ratio in regards to the free cash flow. Make sense?
Yeah.
Perfect. 5-year growth rate of unknown, which is kind of confusing. So they probably cut their dividends recently. They have grown their dividends for 1 year. Their ex-dividend date is actually passed December 7th, and they pay out on December 22nd, and they pay out their dividends quarterly. So that means 4 times a year, right? Make sense?
Yeah.
Perfect. Now coming over here to the actual calculator, we got the ticker symbol EA for Electronic Arts, share price of $125.64, PE of, look at this, sweetheart. What is that PE?
$46.31.
So it's not dollars. This isn't a dollar. This is just a ratio. It's the price divided by the earnings. So a PE of 46.31. We would like to buy anything under 20. The fact that this is 46,
That's not good.
it's not good mainly because it's saying that the price in relationship to the earnings, the price is higher than their earnings. Make sense?
Yeah.
Right? So, but that doesn't necessarily mean that it is a bad buy. We just have to go a little bit further because this PE is only one metric.
Okay.
And the company has a market cap of, look at this, $35.5 billion. First things first, the growth. I am going to assume, sweetheart, a growth rate of around 2%.
Okay.
What do you think about that?
Sounds good.
Are you sure?
I don't know.
Because here's the thing, right? You don't really want to put too much of a growth rate because EA is, right, they're a software company. They make games. How many companies out there make games? A lot, right? So they have a lot of competition, right? I mean, Battlefield alone is competing with Call of Duty. It's competing with Activision. So that's why it's really difficult to come up with a growth assumption because they have a ton of competition, right? So I'm going to assume 2%. Seeking Alpha actually has it at 14.42% for the revenue growth year over year, and the revenue growth forward, they have it at 16.26. My main issue with this is just the fact that we don't know if they're able to grow this much, right? That's 16%, that's huge, and they have a lot of competition. So my assumption is going to be around 2%. Now coming over here to the actual fundamentals, we got the net income. Look at this, sweetheart. $967 million to today, or 1 year ago, of $837 million. That is a decrease of 9%.
Why was it up so much 2 years ago?
So, it's interesting. What happened 2 years ago?
I don't know.
COVID. COVID, remember 2020? Because we're essentially in 2022,
Oh.
right? COVID happened in 2020.
Everybody was home playing video
And
games.
there you go. That explains why the income was such an outlier at the 2020 mark. This is an outlier number. It does skew the numbers a little bit, but as you can see, like even with the projected ones, it's not really that high as 3 billion that it was 2 years ago. I'm really glad that you mentioned that because I was about to ask you that. Very, very nice. So, next we got the free cash flow. And 5 years ago it was about 1.5 billion to 1 year ago of 1.8 billion. That is an increase of 20% with a 5 year free cash flow of $1.6 billion. Sweetheart, why is this free cash flow important? Do you know?
No.
So the reason why it's important is because this is what they use to pay down debt, make acquisitions, pay their dividends, which we know that they have a dividend. So this is what they're going to use to pay out that dividend, right? You want the average 5 year free cash flow to be more than how much in dividends they are paying today. We're going to take a look at that metric a little bit later. But regardless, they have increased their free cash flow 20% within the past 5 years, which is really, really good to see. Next, we got the revenue. 5 years ago of $4.8 billion to 1 year ago of $5.6 billion. That is an increase of 13.93%, almost 14%. Very, very nice, right? It's a pretty nice steady increase, except for 3 years ago. I don't know what necessarily happened, but yep, there you go. Revenue is definitely a check mark because of the fact that it is increasing. So far, the only bad metric is that net income. Next, we got the total debt. And sweetheart, do we want the debt to be going up or to be going down?
Down.
Why?
Does that make sense?
So take it from a personal perspective. If you and your neighbor, you have the exact same house, the exact same car, the exact same everything, but your neighbor has $1 million in debt, but you have $0 in debt. Who is more likely to get into bankruptcy? Your neighbor.
Neighbor.
Right. Your neighbor. So it's all about staying in the game. A company with more debt, the possibility of them going into bankruptcy or their stock going to zero is higher if we get into a depression or a recession. You get me? So that's why you want the debt to be going down. And 5 years ago, it was $990 million to today of almost $2.2 billion. That is an increase in their debt of 54%. Now we come to one of the most important metrics that people tend to overlook, and that is the shares outstanding. So sweetheart, do you want the shares outstanding to be decreasing or increasing? You probably don't know this, but just give it a guess.
Decrease.
Decreasing. And the reason for that is because this is how many shares there are out for people to buy. Think about a piece of pizza, right? If you have 10 people, you split that pizza in 10 different slices, right? So everybody gets 10 pieces of pizza, but the pizza sizes are all the same, right? Now let's say you have the exact same pizza, but instead of 10 people, you have 20 people. Does the slice that you have get bigger or smaller?
Smaller.
Right, so it's the same principles apply. The more shares that there are to buy, the more diluted you are, the less ownership you have. So you want the company to be buying back shares because this gives you, the investor, a bigger piece of that pie. And as we can see right here, 5 years ago it was at 308 million shares to today of 283 million shares. That is a decrease of almost 10% and 8.71%, which is really, really good to see. And lastly, the final metric is the cash and equivalents. And as of today, they have $1.6 billion in cash and equivalents with an average cash and equivalents of almost $3.7 billion. And with all of those metrics, we get a target share price of $124.01. Adjusting for debt, however, which they have a lot of total debt. However, their net debt is actually not that much. This actually goes down to $123.23 with a margin of safety of 5, 10, and 50%. We would ideally like to buy this at $117.07, $110.91, and $104.74. So, just because the PE is a little bit high in this case doesn't necessarily mean that this isn't necessarily a good buy. I mean, we're really, really close to this mark. However, obviously, if you want to have that 10% margin of safety, you want it to go down a little bit more. Now let's actually delve more into this dividend. And as you can see right here, sweetheart, remember how much they paid annually in dividends? It was around 68 cents a share, which this ends up being $193 million every single year they pay out in dividends based on the number of shares, right? Makes sense? Now, after this dividend is paid, they are left with $1.4 billion left. Okay? So this means that their payout ratio in regards to the free cash flow, right? So all I did was just take the free cash flow, which if you remember, it was $1.6 billion, and I subtracted the 192 million. That's how you got $1.4 billion, right? So this is how much money they have left of their free cash flow after paying this dividend. This ends up being around 12.16%, which is really, really good. We want to buy anything under 60. Look at how much they're at, 12.
Wow.
So that means they can actually increase their dividends if they so wish to, because they have a lot of room to increase it. You get me? So all in all, this company is a buy at this point. However, it really is up to you, because there has been a lot of scandals when it comes to this company, underpaid workers and all that stuff, overworked their employees. So it really is up to you. In my personal opinion, I prefer Activision over EA, but that's just me. All in all, right here, $123 after debt, 117 for 5%, 110 for 10%, and 104 for 15% margin of safety. All in all, it's not really that bad of a price right now, in my personal opinion. If you don't agree with my assumptions, with the growth assumption and my required rate of return of 8.5%, maybe you want a higher required rate of return, well, I suggest you get this calculator and you put in the assumptions that you so wish. So that way the price resembles more what you believe the assumption is. So that pretty much does it for this episode. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. I would like to try and get to 250 subscribers by the end of the year. I mean, what were they? What, 243, 242? So if we could get to that 250, that'd be awesome. All right. So like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where in addition to my stock and crypto videos, you will get exclusives as well. Alright, so with that said, peace out and be on the lookout for the next stock analysis video.